Hi everyone, it's Katya and welcome to my channel. Today we are talking about mortgage and finance terms that all of us need to know when getting into a real estate transaction. So let's get started. So first thing we have is earnest money, or so-called reservation fee. Earnest money are usually anywhere between 1 to 5% of a sales price of the home, and earnest money are serving as a reservation for your contract. So basically, when the contract is signed by both the seller and the buyer, reservation fees are there to secure this contract. Now, the reservation fee or earnest money is usually refundable to you within the particular time frames, and I will be talking about that more a little further in the video. Next thing we have is an inspection contingency. Inspection contingency is usually anywhere between 5 to 10 days, and this time is given to the buyer to hire an experienced inspector to make sure that the property is in good condition. So usually the inspector will go in and check the roof, will check the foundation of the home, plumbing work, electrical work, and stuff like that to make sure that you are buying the property that is in good condition. The inspection is usually anywhere between $350 to $1,200. It really depends on what kind of inspection you are choosing. And if something during the inspection, something comes up, the inspector will report it on a report and make sure that he brings it up to your attention. So for example, if it's a major thing, like for example, it's a major roof leak, you will be able to negotiate it with the seller to either repair the roof before the sale of the property, or to negotiate the price down in order for you to be able to repair the roof once you move into the property. And for example, if the seller decides not to negotiate and sell the property just like it is, you are able to withdraw your contract and get your earnest deposit back. Next thing we have is an appraisal contingency. Appraisal contingency is, for example, when you are purchasing a home, the bank that is doing your mortgage sends out a third-party appraisal who will be inspecting the property and giving his opinion of the value of this property. Why is that important? Well, for example, if you're buying a property that the sales price of which is $500,000, but the appraisal comes up and the property does not appraise at $500,000 but appraises at $450,000. So in that case, you are able to negotiate with the seller to either lower the sales price, or if you really like this property, you are able to come up with extra cash out of your pocket and make up for the difference between the appraised price and the sales price, because the bank will only finance what the property appraised for, not the asking price from the seller. There is no reason for bank to finance something that is not worth what the seller is asking for. And just like in inspection contingency, if the seller is not willing to negotiate or lower down the price, or if you do not have cash sufficient enough to come up with that difference that needs to fulfill the seller's asking price, well, in that case, you can cancel the contract and get your earnest deposit back. Next thing we have is a financial contingency. Financial contingency is usually around 21 days for residential transactions and anywhere between 35 and 45 days for a commercial transactions. During financial contingency, you are obtaining your loan. So if you are not able to obtain your loan, you can cancel the contract and get your earnest money refunded to you. Next thing we have, it's a down payment. Down payment is anywhere between 0 to 25% majority of the times. You of course can put as much funds as you would like to put down. It also all depends on the financial situation that you have and on the loan requirements. For example, USDA and VA allow you 100% financing, so you do not have to put anything down. Then on the other hand, you have FHA that requires at least 3.5% down, and conventional that requires at least 3% down. So it all depends on what kind of loan you are able to get. And I will include the links to the videos that I have about FHA, VA, and USDA loans, so you folks can get some more information in regards to those as well. Next thing we have is a loan origination. Loan Loan origination fees are charged by the bank for getting your loan documentation and calculating everything that has to do with your loan. In addition to that, you have a recording fees. Recording fees is for recording your information as the owner of the property. You also have title search and title insurance. Why title search is important? For example, if you buy in a property that is 30 to 40 years old and you buy this property from the seller, well, you just moved into the property. A few months later, somebody shows up at your door and say, hey, my grandfather used to own this property, and the person who sold it to you did some unlawful things, and therefore this property was sold to you unlawfully. Therefore, I'm taking possession of this property because it actually belongs to me. So title insurance, it's actually something that is protecting you as a buyer from a situation like that to happen. And when the title search is done, the title search goes up to 60 years back to make sure that there is no interruption in the chain of the title. You might also have a survey fee. Survey fee is very important. The survey itself is very important because it's important for you to know your property lines. And if, for example, you decide to put a guest house on your property, that you know that your guest house is built within your property lines and you are not stealing any of the land lot from your neighbor. Next thing is credit report fee. The credit report fee is usually charged by the lender for pulling up 3 of your credit scores from 3 different bureaus. We have Experian, Equifax, and TransUnion. So when pulling up your credit history in your credit report, lender usually chooses your middle score, and based on your score, they usually determine your down payment and your interest rate. So credit report fee is usually not expensive. It's usually anywhere between $40 to $80. Attorney fees. Attorney fees are important because attorney is the one who is working on your deed and who is checking your title and who is actually balancing the numbers between anyone who is involved in doing your mortgage to make sure that everything is balanced and all of the numbers are matching between all of the parties that are involved in doing your mortgage and proceeding with your sales transaction. Or if you're the seller, the attorneys are very important as well, because if you have, let's say you sold your property that was fully paid off, the attorney will be transferring your funds to you, so it's important that you folks are having a trusted attorney. Next thing we have is an escrow deposit. Escrow deposit usually includes mortgage insurance if there is any in place, homeowners insurance, and your property taxes. Usually, when you are purchasing your home, you have so-called reserves. Reserves are placed into your escrow account to give your escrow account some cushion. So when you have to pay your property taxes, usually it's once a year, then you have a mortgage insurance. Mortgage insurance is usually dispersed once a year, and you have your homeowners insurance, and homeowners insurance is usually paid either annually or biannually. So your escrow account and your escrow agent is in charge of making that payment on your behalf. Instead of you making a lump sum once a year, you're contributing to your escrow account with every single mortgage payment, and your escrow agent is making that payment to a necessary organization at the time when it's needed. I have another video about escrow accounts and it's completely explained there. I will include a link for you guys right here. Next thing we have is Homeowners Association. Homeowners Association is a good and bad thing at the same time, because from one point, Homeowners Association are the guys who are taking care of your lawn, who are maintaining your pool, making sure that your gym area is clean if you have any of those amenities in your subdivision, in your complex. On the other hand, HOA are the people who are telling you what to do and what not to do. For example, in my HOA, if I want to put something in my backyard, I will have to ask for the permission, because my backyard is open and I have neighbors on the other side. So My neighbors might not want to look at what I have there, so I have to ask for the permission of the HOA. Next thing we have is a discount points. Discount points are usually paid up front, and by paying a discount points, you're usually lowering your interest rate. On average, one discount points is 0.25%. So it makes sense for you to buy discount points if you are planning on keeping this property for more than 10 years. If you are not planning on keeping this property for a long time, there is absolutely no reason for you to buy discount points, because you're prepaying your interest. And if, let's say, you're selling your property in 2 years, you are upside down because you bought interest and you didn't take advantage of you buying that interest. So you prepaid your interest ahead to lower your mortgage payment, but actually didn't bring you any benefit because you only had it for 2 years. So that's why we suggest buying discount points if you keep this property for more than 10 years. And finally, we have an intangible tax and transfer tax. Intangible tax is imposed by some of the county governments and local governments on intangible assets. In our case, it's the house itself, and intangible tax is calculated based on your loan amount, and it's usually $1.50 per every $500 or $3 per $1,000. For example, if your property financed with a loan balance of $550,000, you will have to pay an intangible tax of $1,650 instead of Georgia. Every single state is different. Some of the states do not have intangible tax, so it all depends on the state. And finally, we have a transfer tax. Now, the transfer tax is in place for transferring the title from one person to another person, and it's usually calculated at the rate of $1 per every $1,000. For example, if your property is sold for $500,000, you will incur $500 transfer tax. Just to sum up, these are the main important financial terms and mortgage terms that every single buyer needs to know, every single seller needs to know, because when having the information that is needed from you, information is power. So make sure that you know all of these information and you know what you are charged, so you are not incurring extra fees. Now, it all depends on the state. You might have some fees, you might not have other fees, but at the closing, make sure to ask your closing attorney, your loan officer, your realtor of any of the questions that you have, because in that way you are protecting yourself. Because by knowing everything that you are charged, you are able to either avoid unnecessary charges or plan ahead and know roughly how much funds you would need for your closing, which actually helps you at the beginning when you start saving up for your down payment and your closing costs. Folks, thank you so much for taking time to watch this video. If you have any questions, please feel free to comment below or reach out to me and I will be more than happy to assist you. If this information was useful for you, please click thumbs up and subscribe button, so that way I know that what I'm doing here, it actually helps. Thanks again for your time, and you folks have a great one.